time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
So this is a company that we have some experience with at Keystone under coverage. Why don't we just give the basics on it first? So it's Zynex, ZYXI. This is a US company trading on the NASDAQ, about $9.30 right now. So a small cap, really almost in the US, almost a micro cap still at $340 million total value. And what they do is they're a medical devices company. So they develop, manufacture, and sell medical devices primarily used in pain management and also patient monitoring. But we came across this company before it was NASDAQ listed. We put out a recommendation on the stock in December of 2017. This is when it was still on the OTC. And that recommendation was done at $3 per share. So the thing that we liked about the company is that at the time was very underfollowed business. Nobody knew about it. Here you had this highly profitable micro cap company, very good growth in earnings. They were trading at an attractive valuation. They had a net cash balance sheet as well. And they also were looking to get on the NASDAQ. So that's one of the things that we do like to do with our small cap research and our discovery US research is find companies that are too small for a lot of institutions to look at, really unknown, but where there's a possibility or a good solid potential of a graduation to a senior exchange, as well as improving fundamentals and profitability. And cash flow and revenue as well. But we held this company for a couple of years. It did well. We ended up selling it, putting out a sell report in June of 2019 at $9 per share. So more than about a 200% increase in our initial recommendation. So that was a big win for us. We'd like that. One of the things that drove that price appreciation was that they did graduate to the NASDAQ exchange from the OTC. That, of course, really opens the company up to a far wider range of investors that would not look at over-the-counter or OTC stocks. And it just gives a lot more credibility to the company, the financial disclosures and whatnot. But it did actually continue to go on a pretty solid run after that, reaching a price of about $22 per share before the share price really kind of collapsed over the year after that. So one of the reasons why we decided to put out the sell recommendation is that if you look at the reason why we bought the company, which was really those strong fundamentals, that earnings growth, the solid valuation, attractive valuation, those things really kind of went away for the most part. The profitability was a little more volatile. We weren't seeing the earnings growth tracking the revenue growth as well. The valuation as well expanded, so it started to become expensive. And we saw it really being driven by, that last run up in the price, we saw that really being driven by speculation as opposed to good, solid fundamentals. But anyways, the stock has come down quite a bit from its peak of over $20. And it recently put out Q2 preliminary results. So we're going to take a look at those. Just to take a quick look at the company's business. So there's two areas that they really focus on. There's pain rehabilitation and patient monitoring. So the company has, looks like to me, over a dozen different products, but there are a few products that really produce most of the revenue. In the electrotherapy or pain management segment, it's their Next Wave product that really focus on in the presentation. So they're looking in this segment at a total addressable market of about $900 million. So what their Next Wave product does is it relieves pain, augments healing through electrotherapy. This is a prescription product, so it does require a prescription. Now, one of the things that that is interesting with this product is about 72% of the revenue that they get from their Next Wave comes from supply. So this is what they would refer to as recurring revenue. They sell the product, but then they also provide supplies for that product and generate recurring revenue from that. And then the other side of the business is patient monitoring. They're identifying this as a $3.7 billion business, and they also have a number of products in this space as well. The company also boasts a very solid pipeline. In addition to having over a dozen or so products right now, they also have a pipeline of products coming out to the market. But they put out their preliminary Q2 results. On the revenue side, looks quite good. They're expecting 43.5 to 45.5 million for the second quarter, which should be out soon. So that would be about 21% year over year growth. On the EPS line, much less attractive. They have a range of 3 cents to 7 cents in earnings per share, pretty wide range, and that compares to 8 cents in earnings per share in the same quarter last year. So at the midpoint, you'd be looking about almost a 40% drop in earnings per share. But they have also reiterated their guidance for the full year, expecting 180 to 200 million in revenue and 40 to 50 cents in earnings per share. So on the revenue line, again, about 20% growth over full year 2022 results. On the earnings per share line, you'd be looking at about flat earnings per share on the mid range of their guidance. So they did 44 cents last year, and the guidance suggesting 40 to 50 cents. So really about flat year over year. But outlook for the company from management is strong. Q2 orders increased 51% over the same period last year. Very good sign. They recently received FDA clearance on their CM1600 fluid monitoring system, which provides more comfortable and accurate monitoring to patients in hospitals. So looking to expand that side of the business. Wanted to take a look at just the historic financial performance of Zynex for a moment. So if we look at the revenue performance going back to 2018 to present, we see a pretty consistent increase year over year in the revenues on a quarterly basis and on the full year. So great consistency in the revenue growth. When we look at the earnings per share, certainly we see a lot more volatility. So particularly in the years 2019, 2020, and then at the start of 2021, where they actually in Q1 had a net loss, you can see there's not really a consistent increase in their earnings per share. And it was around, again, Q3 of 2019 that we put out our sell recommendation when earnings per share were actually going down year over year and the share price was going up. Again, we thought that share price appreciation up to the $20 was completely overheated. We had made a lot of money on the stock for our investors, so we thought, fundamentally, it's not a company we would buy right now. There's a lot of risk in holding it, so we're just going to get out of it. A lot of that coming down to just the financial performance, and then in 2020 we saw a drop as well. But you started to see momentum pick up again on the earnings line in 2021, 2022. Towards the latter half of 2022, there's more volatility year over year. And then looking at 2023 again, suggesting flat. So looking at about flat earnings per share. So although we've seen a lot of growth in revenue and that has been consistent, there's been a lot less consistency in the earnings. And that's really the most important metric that we look at. We want to see the revenue growth because without consistent revenue growth, you're not going to get consistent earnings per share growth. But ultimately, as a common stock investor, it's those earnings per share that to us are going to drive the sustainable growth in the share price long term. That's how the company is going to potentially pay dividends or make acquisitions or buy back shares or invest back in the company in a way that doesn't leverage the balance sheet. So from a metric perspective, yeah, we're impressed by the revenue growth, but we're a little less impressed by the earnings per share consistency. Looking at the valuation at the current share price, midpoint of guidance at 45 cents, company's trading about 21 times expected earnings right now. So just to kind of sum things up, our take, it's a very interesting business, a small cap medical devices company. It's growing its revenue. Earnings are growing over time. They're targeting two attractive markets. They have high margins, high recurring revenue. They do have a history of profitability. But where we're a little less impressed here is just there are periods of that lackluster earnings performance, flat earnings for 2023, and then that valuation of 2021 times. It's, I would say, probably within the fair value range. I mean, if you look at profitable medical device companies listed on the NASDAQ exchange, you're generally not getting those companies at a very cheap valuation. So relative to other companies in that space, 20 times does not look very expensive. But we would say, it doesn't look particularly undervalued. It doesn't look particularly overvalued. It's really in that fair value range. But what we really want to see is signals that the earnings per share growth is going to track the revenue growth better. If we saw that, all of a sudden a 20 times multiple starts to look good. But we do see risk in that inconsistency of earnings growth. So we're going to continue to monitor the stock for a while. We'll look at the full quarterly report when it comes out, and then potentially have another conversation with management and just see what the outlook on the company is going forward.
Yeah, Zynex it's interesting. I remember when we were down at a conference in the US, and I saw the CEO present. Stock was trading around like $2.75 to $3, and it had net cash position. It did have earnings on a per share basis, and it was growing. And with their forecast going forward, it was trading around 10 times when you took the cash out of the equation, and the growth was significant. So at that point, smaller business, and it was also like the net income margins were better. If you look at like even at Q1 2019, it did about 9.1 million in revenues and did net income of like 2.3 million, 7 cents per share. Well, if you look at the last quarter of this company, they had 42 million and made net income of 1.6 million, or 4 cents per share. So far more profitable on a net income basis back then. It is, if they can deliver on the guidance they had for this year and start to uptick cash flow and net income margins, it could be a company they revisit, particularly if they can bring online that blood monitoring product and get some diversification, because there have also, like, at times you're willing to take a speculation on a company if you're paying such a low multiple, good cash balance sheet, and good, net income margins at that time. But because there were some questions about the efficacy of the products and risk with some end payers. But if you're paying a very low multiple, you can kind of take that risk. I mean, 20 times is not crazy if they hit their multiples and that consistent track record of revenues, but you're paying, double what we paid back then. And, it was a good situation. It went from $3 and sold at $9, like over a 2.5 year period, or in that range. So that's great. And it was driven by earnings primarily going higher, and then they starting to flatten off to go slightly lower. And that's when we take profits out. Mm-hmm. So yeah, it's an interesting company for sure.
Definitely.